Hi, everyone. Thanks for joining us today for our webinar with Native Land Insurance. My name is Dawn LeBeau. I'm the Senior Program Officer with Occupan. We are a native CDFI doing agriculture lending across the country. And I'll go ahead and introduce our presenters today, go over a little bit of housekeeping things, and then we'll get into the presentation. At Native Land Insurance, they are more than just a provider. They're a partner cultivating resilience and prosperity for Indigenous farmers and ranchers. They're proud to be an Indigenous woman-owned and operated agency guided by their mission to deliver sustainable risk management solutions. Their team brings over 12 years of combined dedicated service and deep-rooted community connections to each partnership. And their experience is working closely with tribal councils, the Department of Natural Resources, grazing associations, and individual members, ensuring a tailored approach that respects and upholds tribal governance and values, with programs federally subsidized by the USDA Risk Management Agency. And we have Miss Brittany Begay with us today, as well as Dugan Kelly. And I'll go ahead and share a little bit about each of them. Brittany Begay is an experienced crop insurance agent and the CEO of Native Land Insurance. She received her bachelor's degree in business administration, magna cum laude, from Arizona State University. She has worked with tribal ranchers throughout New Mexico and Arizona for 5 years in the Pasture, Rangeland and Forage program. Brittany grew up in Seba del Cay, Arizona. Sorry if I mispronounced that, on the Navajo reservation, and she understands the risks and struggles that fall on tribal members and ranchers. She works hard to create sustainable risk management strategies with her clients' best interest in mind. And with a high client retention rate, she's most proud of the relationships that she has cultivated with her clients. With strong ties to Native communities, she hopes to help her Native people thrive through traditions and stewardship of Native lands. And we also have Dugan here with us. Dugan Kelly is a specialist in pasture, rangeland, and forage insurance, and he has spent the past 7 years helping farmers and ranchers manage their risks. He proudly attended Cal Poly and went on to have a successful rodeo career, qualifying for the national finals rodeo 7 times. For the last 5 years, Dugan has worked alongside Brittany Begay to support Native grazing associations and tribes in protecting their essential grazing lands with customized insurance solutions. Outside of his professional life, he enjoys roping, training horses, and assisting ranchers with their daily operations. Dugan's expertise in PRF, combined with his respect for his clients, reflects his commitment to the sustainability and well-being of agriculture communities. His dedication to understanding each customer's unique needs builds strong, lasting relationships they can rely on year after year. And so that's a little bit about both of our presenters today. Thank you for being here with us, Brittany and Dugan. We appreciate your knowledge, your expertise. Our audience is excited to hear about all of the things that you have to offer. A couple of housekeeping things for today. We are recording the webinar. You will be able to watch the recording within a day here once we get it up on our website. And throughout the presentation, you're welcome to use the Q&A box or the chat box to answer questions, and Brittany and Dugan will answer them in real time. We also will have a space at the end of the presentation to ask any follow-up questions that might have come to mind. So please have all of your questions ready to go. And yeah, so thank you all for being here today. I'm going to go ahead and hand it over to Brittany and Dugan.
Hello, everyone. Welcome. We're excited to have you with us today. Today, we're going to discuss 2 risk management tools that help protect your ranching operation from 2 of the biggest risks that fall on ranchers, and that is lack of precipitation and market price drops. So the two programs that we're going to discuss are USDA livestock risk management programs. The first one is going to be the Pasture, Rangeland and Forage insurance program, as well as the livestock risk protection program. So these are designed as a way to create a risk management solution for your operation. I like to thank Dawn and Akitan for inviting us today. Just a little bit about myself. My name is Brittany Begay. I'm from Cibadelki, Arizona, and I'm a member of the Navajo Nation. I have been an agent for over 5 years, providing PRF insurance to tribal ranchers in Arizona, New Mexico, Utah, Wyoming, and Montana, to name a few. And I'm also here with Dugan Kelly, and I'll let him introduce himself.
Hi, everybody. My name is Dugan Kelly. I'm from Pasture, California. I've been a crop insurance agent for the last 7 years and been assisting Brittany Begay for the last 5 years on tribal ranches and ranchers on trust ground. And we just like to thank Dawn and Epicon for letting us present today. And if you have any questions at any time, please don't hesitate to stop and ask us questions, because that's how we learn. So thank you very much.
Yeah, so we're going to go over a little bit about Native Land. So Native Land started as an initiative to support tribal ranchers. There's a lot of distinct challenges that tribal ranchers and farmers face, such as different land statuses that the tribe has and the different tribal governance rules for each tribe. Each tribe is really unique. So we try to work with individual ranchers, whether they're in an association or if they're individual members. We're proud to say that we're one of the only insurance companies that is Indigenous women owned. And below, these are some of the tribes that we currently serve throughout the United States. And then on this page, this is a list of all of the insurance products that we offer. Today, we're going to talk about Pasture, Rangeland, and Forage. And then we also are going to talk about livestock risk protection. For commercial farmers, we have whole farm revenue protection, and as well as multi-peril crop insurance. These two are USDA programs as well. And then we also, another popular program is the Pasture Fire Insurance. This is a private product, and it's for your grazing land. I also wanted to mention that one of the multi-peril crop insurance that might be of interest to you is forage production. So if you grow hay and you receive either a lack of rainfall, pests, wildlife, or any county water restrictions, this would be a good tool for you to incorporate within your operation if you do grow hay. So we're going to break this up into two parts. I'm going to cover Pasture, Rangeland, and Forage, known as PRF. We're going to go over how the program works, the eligibility criteria, and then some of the coverage options, as well as how to sign up for the program. So feel free to use the chat anytime if you have any other questions on any of this, and then we'll also do a Q&A at the end. There's a lot of information on these programs, so we try to keep it simple, but it takes a while to kind of get an understanding of each of them. So we'll also do a comparison on both of them at the end. So going into PRF. So what is PRF insurance? So PRF insurance is rainfall insurance for grazing land. So the USDA created this program to help ranchers stay in business during dry periods. So when it's a dry period, usually there's no grass. So that means you're buying hay or feed or even reducing your herd. So in order to help ranchers stay in business, the USDA created this program to help, pay the ranchers when they are in a dry period. That covers any operational costs that the rancher will need the money for, so such as supplemental feed or either help with their wells or any of their operational cost. So it's all based on precipitation, so rain and snow. So you don't have to prove any damage. It's based off of the weather data from the USDA. So how are you eligible for PRF? So there's really two conditions that are required to be eligible for PRF. So you must either own or lease the land where your livestock graze. So for example, if you have a BLM state or tribal lease in your name, you're eligible to insure any of that land. And then you must also own the livestock that that graze up that area. And then another eligible way that you can be eligible is through hay ground, such as alfalfa fields. And you can only insure PRF with your hay ground, or like I mentioned earlier, forage production. You can't do both in 1 year. So what are some of the benefits of PRF insurance? So the biggest benefit is that it protects you when there is a lack of rain. It's a backup plan to help you with any operational costs. It helps protect your profitability and your longevity for your operation. And it's a simple, hassle-free coverage. You really only have to sign up at the beginning of the year, and you never have to submit claim data or any of that. It's all based off of weather data. And then, of course, it's flexible and customizable. You can choose when and where you want coverage. We can create an affordable premium cost that fits into your budget. The USDA does subsidize the total premium. So their subsidies range from 51 to 59% of the total premium cost. And one of the biggest benefits is that the premium cost is not due up front. Okay, so this is just a brief overview of how the PRF program works. So anytime your operation receives below the average precipitation, you receive what is called an indemnity payment. So indemnity is a payment for your loss in grazing. So these 3 rain vials here just give you an example of kind of how it works. You have your historical average for your ranch, and then you have you can select a coverage level. So you can't insure 100% of the historical average. You can only insure 70 to 90% of the historical average. So depending on how much rainfall you receive, as long as your rainfall comes in below your coverage line, that's when you would receive a benefit. But if your rainfall comes above your coverage line, you would not receive a benefit. But in that case, that means that you are receiving rainfall that goes towards your grazing. In that case, you wouldn't need assistance to pay for supplemental feed. So there's a lot of different parts that go into PRF. So we're just going to cover some of the main parts today, which is the rainfall data, intervals, which are the time periods, the coverage levels, like I just mentioned, and then the grids. So how is the precipitation measured? Who's in charge of gathering all the precipitation? So the National Oceanic and Atmospheric Administration, which is known as NOAA, is in charge of collecting all of the rainfall data for this program. So since 1948, they've been collecting the rainfall data for over 9,000 weather stations throughout the United States. And the data is used to create an average rainfall for each grid. This is kind of a way of keeping things fair for everyone. It's not a perfect system, but at this point, this is the best way that they can ensure that it's fair as possible. So this is an example of a grid here. Grids, the whole United States is split up into grids for the PRF program. They're approximately 12 by 17 miles wide. They do not follow state, county, or any other boundaries. So depending on where your ranch is located, you could be located in one grid, two grids, depending on where it is, how many grids you're located in, you're eligible to use the rainfall data for both grids or either grid. You can choose whichever you like. Okay, so like I mentioned earlier, intervals. So there's a time period for this program. It starts in January and it goes all the way through December. So intervals are the 2-month periods, approximately 60 days long, that you're eligible to insure. So there's 11 total throughout the year. You must choose at least a minimum of 2, and there's a maximum of 6 for each grid. So for example, if you really rely on rainfall in February, March, you would select that grid. Or if you rely on rainfall in May, June, you would select whichever grids are most, I guess, important to your operation. And then there's different coverage options for this policy. So you can select from 70 to 90% of your average rainfall. So you can't do 100% of your average rainfall. And usually, the higher coverage level you select, it's more protection, but it also means a higher cost. So at 70%, you're at a lower level of protection, but it's going to be a lower cost. We usually suggest to our clients to do 85% coverage level, just because it's kind of that mid spot where you take advantage of the low cost, but you still have a high coverage level. And then, like I mentioned earlier, that this is a USDA program. So the USDA is in charge of farm and food initiatives. And the subsidy was given by the USDA to cover a portion of the total premium. So the coverage level that you select determines the subsidy amount you would receive. So at a lower coverage level, you receive more subsidy, but at a higher coverage level, you would receive a lower subsidy amount. So this is kind of where it affects the cost of the premium. So like I mentioned earlier, 85 is really where we recommend our ranchers to select, but we will give you coverage options for each of these. So you can kind of see the difference in the premium costs for each one. So now we're going to go into how indemnity payments are triggered. So this graph here on the left is an example of how indemnity payments are triggered. So this is an example for one grid in January, February from this year. This is in Arizona where the averages are really low. This historical average for this grid is 1.15 inches. So the historical average is this orange line here. And then The elected coverage level for this example is 85%, which is the yellow line. And then the actual precipitation that this grid received is the blue line. So you can see for this interval in this month, it was very dry. So anytime this blue line is underneath the yellow line is when you would receive a payment for your loss. So the higher it goes, the less you would receive, and the lower it stays, the more you would receive. So if this blue line goes over the yellow line, you wouldn't receive any indemnity because you received over your coverage level. So indemnity payment. So with this PRF program, there's no premium payment required up front. You would sign up in December, and then any benefits that you receive from the program would go towards your premium first. And there is a balance due by September 30th, and you would have to pay the approved insurance provider directly. Of course, it takes NOAA about 60 to 90 days after an interval is finalized to finally send payment to insureds. So, for example, if you receive benefits in January, February, after February, it would take about 2 months to receive payment for that interval. So March, April, you would receive a payment probably the beginning of May for that interval. So this is a timeline of the program. So the sales closing date for 2026 is December 1st. You would have to submit your application. You would select your coverage level, how many acres you want to insure. And then your premium, of course, isn't due up front. Your insurance would start on January 1st. And then any benefits you make go towards your premium bill. And then on September 30th, if that premium bill hasn't been paid off, that's when you would have to make a payment toward your premium. Of course, we also have payment plans available for some of our AIPs. So if you're an insured and you have a bill due on September 30th, we can actually extend that deadline until the following year. Usually it's due until June, but the only I guess the only risk would be that they do charge an interest every month. So the interest is usually around 1.6%. It just depends on the year. Every year it's a little bit different, but it's usually around that percentage. And then on December 31st, that would mark the end of your insurance period. And then it starts all over again. So you would have to be signed up before December 1st again, if you would like to participate the next year. So if you're interested in enrolling in the PRF program, this is a little guide on how you can get started. So of course you would want to contact an insurance agent, just depending on whoever you want to work with. You would select an agent. You would have to have this information ready. So if you work with the Farm Service Agency, they usually issue a 578 report. And in that report, it has your farm track and field numbers. We could use that to determine your grazing acres, or if you have a map of your pasture or any of your hay fields. But one thing to note is that you must own or lease the land that you're wanting to insure. And it must be in your name, or if you have like a sublease, they will accept that. And then from there, you would choose your coverage details. So you would choose how many acres you want to insure, which coverage level you want to select, and then you would select which intervals you want to insure. And then you would just submit your application before the deadline of December 1st. So here's a little review of the PRF program. So it's a USDA subsidized risk management tool. Most people refer to it as drought insurance, but you really don't have to be in a drought to receive benefits from this program. The drought monitor LFP is usually, you can use LFP and PRF in conjunction. So LFP, it's a FSA program. And usually a lot of tribal ranchers, there's really no cost for tribal ranchers. So you can use LFP and PRF. Only the NOAA weather station are used to collect precipitation data. From a lot of ranchers, they mentioned that they collect their own precipitation data on their ranch, but that data is not allowed to be used. Only the NOAA weather stations are approved. And then there's no premium up front. The policy credits the premium amount until it's paid in full. And then after the premium is paid is when you would finally start receiving indemnity payments. And then, of course, this is a year-to-year policy. So you have the ability to change your coverage in acres from year to year. You don't have to enroll all of your acres. You can select how many acres you actually want to insure. So if we have any questions on PRF.
I don't see any questions in the chat box yet, Brittany, but every question I had, you answered. So you were pretty thorough. So thank you.
All right, perfect. So next we'll go on to Dugan.
All right. So now we're going to talk about LRP, and LRP is livestock risk protection. And LRP is a risk management tool. It's provided by the USDA Risk Management Agency, the RMA, and it helps protect livestock producers against unexpected price declines in the market. So it protects you against the market dropping around the time period that you market your cattle. So Brittany's going to have to change the slides. There we go. So why is LRP insurance important? So LRP is price volatility. So livestock markets are volatile, affected by global events, weather conditions, and market shifts. So LRP gives you financial security. It protects against unexpected price declines that could threaten profitability. And LRP is a peace of mind. It allows producers to focus on managing their operations without constant fear of price drops. So the price of livestock can drop 30 to 50 cents a pound during a time period. If you sell your cattle, LRP can protect you against that risk. So for an example, if you have an 800-pound steer, and if the market drops 30 cents a pound during the time period that you sell your cattle, that market dropped $240 a head, and the LRP protects you against that risk. So who can benefit from LRP? So livestock producers, specifically for producers of fed cattle, feeder cattle, unborn cattle, and swine. You can only insure the amount of head that you own. So if you buy stockers today for $3 a pound, for example, and you can insure against the national market for $3 a pound at the time period that you are going to sell your cattle, this might be a good management tool for your operation. So if you get a loan to purchase the cattle, bankers love LRPs because it protects a portion of the loan. And if you have a cow-calf operation, and because the market is currently high, you can ensure that the national average price remains high around the time period that you normally sell your cattle. So you can insure your calves 52 weeks out, which is before they are born. So you just need a preg check to verify that the amount of head you insured is pregnant. So you can insure a good price on your calves a year away, which is 52 weeks.
Hey, Dugan, before you move on, there is a question.
Okay.
Curious if you have to have FSA maps, farms, tracks to be a part of these risk programs.
So for LRP, you don't have to have your ranch mapped. You have to have a 1026 on file with the FSA office, which is just a signature on a conservation compliance. And that makes you eligible for the subsidy. But that you don't have to have your ranch mapped. No, just a 1026 on file with the FSA office and Farm Service Agency.
With PRF, you don't have to have it mapped as well. We could create a map for you in what's called an RLU, and that is sufficient for the program.
Cool. Thank you, guys.
Okay, so LRP, the types of classifications. So there's feeder cattle, which is 599 pounds and below. And there's a class of steers and heifer price. The heifers are 10% less than the steers, and that is weight 1. Then there's weight 2, which is feeder cattle, 600 to 1,000 pounds. And there's a steer and heifer class, and the heifers are 10% less than the steers as well. And then there's fed cattle, which is 1,000 to 1,600 pounds, and there's just one price for all the cattle in that weight group. And then there's unborn cattle, which is 599 pounds and below, and that is using the weight class 1, and that is one price as well, which is 5% less than the steers and 5% more than the heifers. So they average the steer and heifer price of weight 1 and count all of them as one cost. So the duration of the contracts. So these are all the different offers that they offer, and it goes from 13 to 52 weeks. So starting at 13 weeks, there's an offer every 4 weeks until you get to 52 weeks. So all the offers are not always available from day to day. So when the market gets real volatile, the longer offers are not always there. So when can I buy a contract? So LRP is offered daily, Monday through Friday, except for on holidays. Market prices are released daily at 2 p.m. Central Time. Contracts must be selected and signed the same day by 10 p.m. to be accepted. So we can set you up on a daily email to see the offers every day, and it'll get to you every day at 2 p.m. Central Time. So when you see a price that makes sense to your operation, you can call us so we can go over the details of the offer versus what the CME index price is for today. So you can see if you are looking at a higher or lower price compared to today's market. So we like to look at today's market versus the offer so that we know that we're buying a price that's higher or relative to the same price of today. So if the offer makes sense, we will send you a contract to sign, and we'll need that signed and sent back to us that same day. So you can scan it back to us, or you can DocuSign. So then coverage levels. So coverage levels and payment. So coverage levels, producers can select from different coverage levels ranging from 70 to 100% of the expected market price. Higher coverage levels equals more protection, but it also means higher premium cost. So premium payments. Producers pay premiums, which are calculated based on the coverage level, the type of livestock, and the amount of head that you purchase. Indemnity payments. If the actual market price at the time of the settlement is lower than the insured price, an indemnity payment will go to the premium first, then any potential net benefits will go to the producer. So the premium is not due until 30 days after the end of the end date. And if indemnities are released, if they're going to pay you an indemnity, if the price is below what you locked in, you have to submit paperwork showing that you have the amount of livestock that you purchased. And once they receive that, they will release the indemnity to you 30 days from that point. So how to enroll in LRP insurance. So contact an authorized insurance agent, fill out an application to get pre-approved to participate. And that means, so it's a subsidized program. So you have to have a 1026 on file at the FSA office, the Farm Service Agency office. Review daily LRP offers. So we can email you these offers every day. Choose the livestock type, coverage level, and period. So find your classification, what coverage level you want to choose, and when you normally sell your cattle. Sign the application before 10 p.m. on the day the contract start date. So if you like an offer and you want a contract, contact us. We'll put it in the system. We'll send you something to sign. You'll have to sign it and scan it back, or you can DocuSign, but we would need it back that same day because the next day a new offer comes out. These offers come out every day and they change from day to day. Receive end of contract email detailing final index price. So if you lock in something for November 15th, when November 15th happens, we're going to send you an email letting you know that the index was below or above what you locked in. And that'll tell you whether you owe the premium or if there's indemnity due, and it'll tell you how much. So submit a claim or pay premium dependent on final index. So if a claim is established and that market is below what you locked in, we'll ask you to send us documentation that you have a bill of sale or a brand inspection or a veterinary inspection showing that you have the amount of livestock that you locked in and they are within the weight class that you locked in and the amount of head that you locked in. And we will turn that into the insurance provider, and then they will mail you a check at that point. If it's above, if the index price is above what you locked in, then we'll send you a notice that a premium will be due and you'll have 30 days to pay that premium. Okay, timeline. So first, we have to fill out an application. So an application gets you pre-approved to purchase an LRP, but it does not obligate you to have to purchase an LRP. So basically, they're just checking to make sure that you're a producer, you have a 1026 on file at the FSA office, and that makes you eligible to be in the program, but it doesn't obligate you to have to do it. It just gets you pre-approved. So you would want to do this beforehand, before you're interested in doing it. And even if you're thinking about it, just go ahead and sign it because it doesn't obligate you to anything. It just allows you to participate if you want to down the road. And then select price, sign contract. So the next step would be to get the emails, get the offers, choose a type of livestock, the weight class, your coverage level, your end date, and decide what LRP offer makes sense to your operation. So once you do that, we send you something to sign, you send it back, you got a contract. From that point, the next step is the end of the endorsement. So at the end of your coverage period, the actual ending value is determined by 15 sales yards that sell that day. So if you lock in November 15th for $3 a pound and November 15th happens and it's $2.80 a pound, then they're going to take the premium out and pay you the difference. If it's you locked in $3 a pound and the index of that day is 310 or 320, that's over what you locked in, then they're going to send you a bill, you pay your premium, and you have 30 days to pay that premium. So that's the next step. You either receive an indemnity or you receive a bill at that point. And again, if you are going to get an indemnity, then that at that point, you're going to have to show some type of verification that you own that amount of cattle that you locked in, whether it be brand inspection, hauling papers, vet inspection, or if you sold the cattle, a bill of sale, or if you bought them, you could do that as well. But you have to maintain ownership of these cattle within 60 days of that end date. So you can sell them before that date, but no more than 60 days before that date. You can keep the cattle past that date. You don't even have to sell the cattle if you don't want to. If the prices are too low and you don't want to sell them, you want to keep the cattle, you don't have to sell them. So that's kind of the timeline there. So here's an example, scenario one. So a cattle rancher buys an LRP insurance for a 599 pound steer. His expected price is $290 per hundredweight. The premium cost is $10 per hundredweight. So at this end date, the actual market price drops to $270 per hundredweight at the time of the settlement. So for this example, the rancher receives an indemnity payment to cover the loss of that $20 difference. But first, they're going to take that $10 premium cost out of it, and then they're going to mail you a check for the remainder $10 difference. So here's scenario number two. Same rancher buys an LRP for a 599 pound steer. Expected value is $290 per hundredweight. Premium cost is at $10 per hundredweight. The actual market increases to $300 per hundredweight at the end of the contract date. So that was over what he locked in. So the rancher would receive a bill and have 30 days to pay that premium of the $10 per hundredweight times the amount of head that he purchased. So the challenges and something to consider, it doesn't matter what you actually sell your cattle for. It doesn't go off of what you sell your cattle for. It goes off of the index, which is the sales yards that sell that day. And they average those prices, and that's the price you're going against. So it's just price protection. So the market limitations, LRP is based on a national market price, which may not reflect your local or actual prices. So you might sell your cattle for more than you locked your cattle in, or you might got it less. At the end of the day, all that matters is what the national average was of that day. That's the price you're going against. And so it doesn't protect you against death of livestock. If you have cattle die, it doesn't protect you against that. It only protects the price value of the amount of head that you purchased. So you must show proof of livestock ownership on the amount of livestock that you insured. So if you insured 100 head, we need a receipt showing that you owned 100 head that were in that weight class in your name within that time period that you insured them. So things to consider. So know your budget the cost of the premium into your operation as a safety net, and compare the index prices. So review the daily CMA index prices compared to the daily LRP offers. So to really understand if an offer's good to purchase, you have to really know what the index price of today is. So if today's index price is $3 a pound and the offer is $3.20, then it's a good offer because it's higher than today's market if you're happy with today's market. If it's the opposite and the index of today is $3.20 a pound and the offer's $2.80, then that's a lot less than today's market. It's probably not a good offer to purchase. So you really have to understand what the index of today is, where the market is, and what the offers are, and compare today's market versus the offer, and to really understand it. So this website right here, this QR code, you can scan that QR code and it'll tell you right to the CME index. It'll bring you to the index website, and you will actually be able to see what the CME index price of today is, so that you can take that number and compare it to the offers to know whether it's a good offer or not. So for LRP review, it is a USDA subsidized risk management tool. It is based on the CMA market prices. It does not matter what you actually sell your cattle for. There's no premium due up front. Producers are able to market and sell livestock within 60 days of the end date of the endorsement, but they are not actually required to sell their livestock. So you can sell your cattle up to 60 days before that date, and no more than 60 days. The no minimum number of head required. You can purchase 40, 50, 60, whatever number you have. You just can only purchase up to 12,000 head per purchase, and a limit of 25,000 head per year. And it is not mortality insurance. It is just price protection against the market.
Hey, Dugan, there's a couple of questions in the chat, and I'll read them off to you here.
Okay.
Okay, this one says, will they run out, or can the funds be taken away from the program like we've seen done already? I don't want to get political on this at all, but as a producer who had REAP funds frozen and knowing we cannot see into the future, what is USDA feeling on this? Are these funds secured? I don't want to buy into the program and then come fall, if the markets crash, USDA says, sorry, we can't pay out, or we can only pay a small percentage like they did with PARP.
So this is crop insurance. So the way that crop insurance works is when you sign up and say it's subsidized, whatever percent, 50%. When you sign up, that subsidy money comes from the government and goes to the insurance carrier to pay your losses. So whether they pay you or you pay them, the insurance company is the one that's going to be paying out. It's not the government entity. So it's not, if you sign up today, that subsidy money is going to the insurance carrier, and the insurance carrier is responsible to pay you if there's a loss. And that money would come from the insurance company, not a government entity.
Thanks, Dugan. One more here. Can you please confirm if the market price rises above price that you locked in, you will owe a premium whether you sell cattle or not? So you pay a premium for the policy and then pay additional premium if the price rises?
No, so the price can go up or down, and it really doesn't matter where it goes until that end date. When that end date happens, let's call it November 15th, the market could go up 50 cents, drop 30 cents, back. It could go back and forth until that November 15th date. All that really matters is that date that you locked in. And at that point, if the market has rose above what you locked in, then you would owe the premium. That it'd be the same premium that you signed off on at the beginning. If it was below what you locked in, depending on how much below is how much they would pay you. So if it was $10 less than what you locked in, then they're going to pay your premium out of that and then pay you the remainder. If it was $1 under, they're going to pay that premium, that dollar towards your premium. So it has to drop as much as your premium is to be able to benefit from the program. So typically the premium can range from $3 to $12 a hundredweight, depending on how far out your contract is. The closer it is, the cheaper it is. So a 13-week contract is going to be cheaper than a 52-week contract because you're insuring it, a year out. So they're going to take their premium out of that net indemnity first, and if there's money left over, they're going to mail you a check. If there's not, you would owe the difference. It really just depends on where the index ends up of that date that you locked in.
Okay, thanks, Dugan. All right, another question. Can you give any examples of where you have seen this before? A good
Yeah.
product for farmers? Is it not as useful for small farmers?
Yeah, so I actually had a guy last year locked some cattle in for December of last year, and he only locked in 38 head. And the price dropped, I believe it dropped 40 cents a pound, which is $40 a hundredweight. And his premium was $6 a hundredweight. So he locked in 8 weights. So basically, $36 times 8 is what? Let me get my handy calculator. So he netted, after it paid his premium, he netted $288 a head after the policy actually paid for itself. So he locked in 36 head times 288. So he netted $10,000 off of 38 head of cattle. So it really protects you when that market drops 30, 40, 50 cents a pound. And it really doesn't matter why it drops. It could be government deals or tariff scare, or it could be E. coli, it could be whatever. It doesn't really matter. But that market here in the last year and a half has dropped 30 to 40 cents 3 times in the last year and a half. So it just protects you from that time period that you're selling your cattle. When that market drops, for whatever reason, it's going to protect you from that.
Okay, thank you. I don't see any questions in the chat.
Okay. So now we're just going to do like a little comparison between PRF and LRP. So you can participate in both of these programs at the same time. They're just kind of geared towards different objectives. So for PRF, it covers a lack of precipitation, and then LRP covers market price drops. And then there's different triggers for each of these perils. So for PRF, they go off the NOAA rainfall data. And then for LRPs, it's all off of the CME index. And then their requirements for each are PRF has one additional requirement, and that is that you must have a lease or ownership documents in your name. And of course, you must show proof of like cattle ownership. And then for LRP, you would have to show proof of livestock ownership, of course, if you receive an indemnity. And then both, the premium is not due up front for both. There's a set price for each program at the beginning when you sign your policy. So you'll know your premium cost for your PRF and your LRP beforehand, and that does not change throughout your policy. For PRF, the premium bill due date is September 30th. And then for LRP, at the end of an endorsement period, if the market doesn't drop, you have 30 days to pay your premium cost. And then for indemnities, for PRF, it takes NOAA about 60 to 90 days to finalize their results. So once your premium has been fully paid, they issue payments 60 to 90 days after an interval is complete. But for LRP, if the prices do drop, it takes them about 60 days at the end of an endorsement period to send you an indemnity payment. PRF is best for grazing risks, and then LRP is best for price protection. So you can use both of these programs together as a way to create your risk or spread your risk. So here's some of the things that we are I guess, that we're focused on. We're experts in crop insurance. We are built for producers by people who actually understand some of the challenges that Indigenous producers face. Growing up on the reservation, I kind of understand some of the challenges that we're faced with. And then, of course, we do a lot of personalized service. So we do a lot of one-on-one support, and we're really proud of all of the long-term relationships that we create with our customers. Of course, there's a lot of coverage options that we do provide, from PRF, LRP, and then we also do individual crops and then whole farm revenue protection. We try to make sure that we create custom plans that fit your operation and budget. And of course, our biggest thing that we like to focus on is our customer support. So we always try to answer your calls and respond to your emails as quickly as we can. And then, of course, we have exclusive software that helps us create efficient and tailored services to our clients. We send out report updates at the completion of every interval. That way you stay up to date with the rainfall data that you received, if you're going to expect an indemnity payment, or if you're going to have to pay your premium. We like to keep our customers updated. And then, of course, just educating our customers on the programs. We want you to understand your coverage options, as well as how all of these programs work. So if you're interested in any of these programs that we went over today, you can always reach out to us to get a quote for your operation. You can either request a quote online on our website, and I'll share that website address in a bit. We try to respond to you within 48 hours. There you'll put your location, if you have a tribal affiliation, and you would select which program you're interested in. And then we can always do on-site visits with you in person. And from there, we can kind of go over any questions you might have. And then we would also provide different coverage options for each of these programs. So there's different coverage levels. So we would give you an option for each coverage level, and we would go over them individually and kind of go over the pros and cons of each one. Of course, getting a quote from us is 100% free, and you're not obligated to sign up with us. This is just a way to see some of your options that you are able to protect your operation with. So this is our phone number. If you want to email us, you can email us at info@nativelandins.com, or you can go to our website, nativelandins.com. And that concludes our presentation. I don't think there's any other questions.
Thank you, Brittany and Dugan. You're right. I don't see any further questions, but we can hang out for a little bit longer. We did give the presentation a little bit more time.
Okay.
Just gonna do a couple closeout things, and then we'll close it out from there. But thank you again, Brittany and Dugan, for your time and your expertise. If anybody has any follow-up questions for either of them, their info is on the screen here. This is being recorded, so it's going to be on our website tomorrow. If you want to revisit it and go over some of the examples and details that Brittany and Dugan offered, it's on our website under webinar recordings. We offer these webinars every month. We have a few new ones coming up here this summer. We're going to go over some record keeping on June 17th, succession planning on July 10th. The NRCS is going to be with us on July 16th, and the Intertribal Agriculture Council Food Business Center will be with us in August. You can view all of these webinars and sign up for them on our website under events. I will be sending out a survey to hear from you all about this webinar and future webinars that y'all want to see. So again, Thank you everyone for taking the time out of your day to build your knowledge for your ag operation. We appreciate it. I'm going to go ahead and read this last question in the chat here. I don't want to leave anybody out. The question is, you mentioned LFP also. Can you say how that is different than the other programs? So we'll just circle back here and stay on.
So LFP is a FSA program, and it goes off of the drought monitor. So I believe the drought monitor is, I don't know if you know this, Dugan, is it below 50% of the average?
Yeah, so the drought monitor is a county-wide program. So if the whole county as a whole is below 50% of normal for 90 days, then that triggers a payment through the LFP. And that is a FSA program, and you can do both programs at the same time. You can do the LFP and the PRF at the same time. The PRF is more specific to your area, more of a 12 by 17 mile area versus the whole county. The bad thing about LFP is if one part of the county is above 50% and the other part of the county is below, then sometimes it doesn't trigger a payment to you. So ours is just more specific to your area, but it is insurance policy with the premium, where LFP is a cheaper sign up, but you can do both programs.
Yeah, and the LFP for tribal ranchers, I believe the fee is waived. So it is free for tribal ranchers to participate in that one, which I suggest all of the tribal ranchers get. I start participating in that program versus PRF, where there is a premium cost.
That might have answered the other question in the chat, but I'll read it out loud just to be on the safe side. LFP is a free program and PRF is a coverage, correct?
Yeah, so for non-tribal ranchers, there is a fee, but if you're a tribal rancher, then it is free.